All right, this year's record rally in emerging markets propelled valuations above U.S. shares for the first time since October of 2007. The last time stocks in developing nations got this expensive was right before they began a 12-month tumble that erased half of their value. Barton Biggs runs a hedge fund, Traxis Partners, and called Chinese stocks a buy as recently as May. Since then, they're up, I guess, about 20%. Barton, thanks for joining us. Firstly, I'm wondering if you still think Chinese stocks or China is one of the best places in the world to invest after this run-up.
Yes, I do.
And emerging markets in general, I mean, are you concerned about the valuations, or do you think that's the place to be?
Well, I mean, I saw your story this morning, and I don't know exactly where you get those valuations from, and we tended to look at what we hope are reasonable and conservative estimates of next 12 months earnings, and the stocks are and the markets are not as expensive as you portrayed them. But yeah, I mean, I still think the emerging markets, particularly Asia, are the growth areas of the world, and that they're emerging from this financial crisis and economic crisis faster and better than any other part of the world. And I think that, and we've tried to do a lot of work on it, and we think that that the surprise is going to be how strong their recovery is going to be in the next 2 or 3 quarters.
Barton, what kind of surprise? I mean, in terms of the growth, I mean, what do you anticipate based on what your analysis and what you're seeing when it comes to those emerging market areas?
Well, I mean, look, each one is different, and I mean, and the specific numbers for each one are different.
Mm-hmm.
But I believe that in the case of China, industrial production and GDP growth is going to be 2 to 3 percentage points higher than the consensus. Consensus is probably 12%. I think it could be 15, 17%. And I think the same thing applies to industrial production. And you go through these various countries and the various markets, and the surprises are going to be on the upside. And in Asia, it's Korea, Indonesia, to a certain extent Malaysia, Taiwan.
Mm-hmm.
Markets like the economies like that are all going to do better than people had thought.
All right, Barton, we're going to take a quick break here. Just a quick commercial break. You'll stay with us, hopefully. Barton Biggs on emerging markets. He runs a fund manager at Traxis Partners.
Mm-hmm.
But he made the right call on China stocks. He also made the right call on treasuries, and we'll talk about that as well. All right, we are back with Barton Biggs, who runs a hedge fund, Traxis Partners. And Barton, I don't want to spend too much time talking about China, but obviously there's a stimulus play over there as well. Are you concerned that they'll run into an inflationary problem? Because obviously the growth rates are much higher than we're used to dealing with over here.
Yeah, I'm sure they're going to run into an inflationary problem eventually, just like we are. But there's still a huge output gap. There's still a lot of deflationary pressures in their economy, just as there is in ours. There are some signs that wages are actually declining in China. So, yeah, there's going to be problems in the long run if the central banks don't mop up the excess liquidity. But it's too far away for me to worry about too much now.
Barton, I do want to ask you about the Treasury trade. Back in late May, you said you saw a buying opportunity in the 10-year Treasury notes. We have seen quite a move into Treasuries despite all the supply out there. What's your take on Treasuries? Are there still opportunities out there?
No, I don't think so. I mean, the 10-year and the 30-year, but 10-year particularly, has had a good move, and I think enough's enough. And since I believe that the economic recovery is in place, it may be in the form of a U rather than a V, but that all these worries about recovery are misplaced. About there being no recovery are misplaced, and so in that being the situation, I think we've had a pretty good move in the Treasury and in the Treasury market, and I'd lay off it.
Does that mean you're still hopeful for stocks to continue their rise? I mean, we've had kind of a turnaround here. You have said you think the S&P should be around 1,000 by the end of the year. Do you still see it going there?
Yeah, I do, and maybe a little higher than that.
Aren't you concerned, though, about the labor picture? I mean, a lot of people are saying this time it's going to be different, the recovery from this recession. You know, jobless recovery may be the way we go forward from now on. The labor numbers may be a leading indicator rather than a lagging indicator. It just seems like a much worse situation, maybe, of course, because we're in it right now.
No, I mean, I think there are some leading indicators of what the employment numbers are that have already started to roll over, like new unemployment claims and things such as that. And actually, some of our work suggests that the new orders part of the PMI is a good leading indicator, and it also is signaling that that we're getting close to the peak in the raw unemployment numbers, and that the number of new people becoming unemployed is beginning to decline. So I'm not that concerned about it.
So Barton, having said that, we just got 40 seconds left here. We've seen quite a pullback in stocks over the last 4 weeks. Would you take that as a buying opportunity?
Yes.
That was quick. Where would you be buying? Because we got another 20 seconds left.
Well, I mean, I think that I still think that tech in the U.S. is a good buy, and I think that probably Asia, some of the Asian markets are still attractive. They've all had 10, 12% pullbacks. Again, China, Hong Kong, some markets like that. Mm-hmm. And then I wouldn't be surprised if Japan isn't a buy right in here right now.
Hey, Barton.
I mean, by right now, I mean.
If you
go ahead, Matt.
Sorry, if you have a minute, we got to take a quick break, but I want to come back and just ask you a couple of questions about stimulus, because it's a hot topic and obviously it can change the way people in the U.S. Or people invest here in the U.S. We're going to take a quick break. Right back with more from Barton Biggs. All right, we are back with Barton Biggs from Traxis Partners. And Barton, I just wanted to ask quickly about the stimulus package here. You are confident in a recovery. You think we'll see a U-shaped recovery. But a lot of people we talk to say we're just going to get a bump up because of the stimulus as it enters the economy and then come back down because the fundamentals are so bad. Why do you disagree?
Well, I disagree because I think that the PMIs and the ISMs and the forward-looking stuff, the forward-looking high-frequency data, suggests that we are going to get not just a stabilization of the economy, but a recovery. In other words, we're not going to have a L-shaped stabilization. We're going to have more of a U-shaped recovery. And I think everybody is, a little crazy to think that that immediately we're going to see definite signs of a resurgence of economic growth. And we're not getting that. I mean, the last 4 or 5 weeks, retail activity has actually been pretty soft. But that doesn't cause me to think that we're not going to get the recovery after all. And for all I know, it could be beginning now, or it could begin at the end of the summer. Who knows? But I think we are going to get a decent recovery, and that as I say, that the configuration of it is going to be a U. So
are you not concerned about a new norm of only 2% growth? Do you think we actually go back to what we're used to with, say, 5% unemployment?
Look, we're way below where we were. So I'm talking about the recovery back up to trend line growth. And what will trend line growth in the United States be over the next 5 years? My guess would be more like 2%. Maybe 1 3/4, 1.5%, 2%. But it's going to be slower than it has been for a while. But that doesn't mean that in this recovery stage that we can't have a pretty powerful push off the bottom that I think we're emerging from right now.
Hey, Barton, just 30 seconds left here. So what's the biggest risk out there, in your view, that could kind of change your thinking about the outlook? Or at this point, do you think all those risks are off the table?
Well, look, the biggest risk is that something that could happen that would drive up oil prices very significantly. The biggest risk is that something that could happen that would would cause a very sharp rise in the 10-year interest rate, and both of those things would be bad for the consumer and the shape of the recovery that I'm looking for.
But you don't think
so
that's
I'd be worried about those.
You're not.
All right. Well, we hope those things don't happen as well. Barton Biggs, thank you so much for joining us. Barton Biggs there from Traxis Partners.